We're delighted to be joined live from Boston by Bridget Realmuto, LaPerla of State Street, and it's a pleasure to have her with us today. And without further ado, because I'm aware of time, we're jumping right away into the interview with Bridget. And first, I wanted to ask you a question about your life story, because I think you have a very unique CV. I mean, you started at the City of New York municipality, and I think you did some pioneering work on quantifying social impact, measuring the S in ESG, as we say, long before it became a fashionable issue for policymakers and pension investors. So the question I'd like to ask you today about, your life story, how did you move into that space, and how difficult was it back then to bring all stakeholders on board? What lessons have you learned?
Yeah, thank you so much for having me, and thank you for that question to kind of set the stage. So one big takeaway here will be, and from my experience has been that there's always room to learn more about ESG data. It's come a long way, and it really behooves investors to lean into the complexity as this space continues to grow. So my work for the City of New York was a great introduction to ESG data creation and design, which is really important for research. My time there was just after the first social impact bond had been launched in the UK in 2010. And social impact bonds, as many may know, are unique performance-based contracts for public-private partnerships that engage investors and government agencies for social services and programs that, while critical, are underfunded for various reasons. So at the time, I was working with a team to evaluate the city's homeless prevention programming in an effort to facilitate stable housing for low-income and at-risk communities. And the logic behind that is that this prevention programming helps people stay out of shelters, which were known to have high recidivism, and can be extremely destabilizing for not only the families, but the economies that those families contribute to. And as many types of prevention programming, it can be really difficult to capture the impact. And what does success mean? It's very complex to capture, and it's really, think of it as almost like a mosaic of services that are seamlessly working together to serve these clients. And so when we were faced with the challenge, as many investors are now, what is the impact of my investment? How do you quantify it? How do you track it? How do you report it? And how do you do that objectively? And so for thousands of clients at the time that were using the prevention programming, what other services are they using? And does using more services help? We had to answer all of these questions, and that meant understanding really the ecosystem. And so to your point, you were talking about, how did we all come together? It meant we had to partner. We were partnering at the time with legal services, and that's linked to like illegal lockouts. We were working with other city agencies. And this took time. We also had to work with nonprofits in this space. And so it took time to not only align goals between these groups, but then also define metrics that could be not just defined, but consistently measured. And so that's where you are able to set up a track record for and study it, right? And so since my time working for the City of New York, I've been able to leverage what we learned there. So I've worked on buy-side ESG research at an impact investing firm, focus on, the tech and energy sector, listed equities, fixed income. I moved to sell-side research at an environmental data provider. And now, I have the pleasure of diving deeper into all different ESG data as part of a quant research team at State Street Associates. State Street Associates, for context, it's the academic affiliate of State Street. And we work with our partner, Professor George Serafem, there to put out new research and insights. And so I facilitate sustainable economies by enhancing the science of portfolio management and then engaging with clients on these insights. And really the big takeaway here is that ESG data, as with any data, can and should be scrutinized. You shouldn't assume that it's perfect, but really has come a long way. And really there are unavoidable subjective decisions when you are creating objective data. This is true for ESG data as it was with accounting and audited data. Which specific measure is telling you what, and is that answering your question that you're trying to assess? this is why you use EBIT instead of EBITDA, and it's the same true for ESG measures. And so we know that it's come a long way, and actually we're seeing really exciting developments with new technologies, which we've leveraged in some of our research already, and new frameworks that are leveraging leading research in this space. And so an example of that is the impact weighted accounts initiative out of Harvard that really moves beyond efforts to not just assess, kind of what's happening, but actually capturing outcomes. So it's an exciting space to watch.
It's great. And actually, I wasn't aware that in New York City, part of the inspiration 10, 11 years ago came from London. And Olivier must be smiling also, because we had Sir Ronald Cohen here
yes.
last month, who's the one of the inventors of the social impact bonds. And I like the word ecosystem, because as Sir Cohen is British, and I just learned, thanks to you, that he had influence indirectly on the thinking of policymakers in New York. And what's interesting is earlier in life, he lived and worked in Boston for many years, because he went to Harvard University, and he studied there, and he worked there. So and I guess you guys are both, State Street, you're based in Boston. So it's really a circular, interconnected, Atlantic continuum or ecosystem where ideas and investments circulate, which is very interesting. Now, from Boston and London back to, I guess, Asia or Eurasia. I think earlier this year, I think you co-authored with your State Street colleague, I think Travis Whitmore, a paper which got a lot of attention across Asia, notably in Japan. And I think the starting point of your reflection was a big event that shocked many people that took place, a bit before Christmas in 2019, which was, the abrupt or perceived as abrupt decision or the determination by the Japan's government pension fund, all of a sudden, to suspend their lending program. And it's a clear sign, that decisions taken by large asset owners, sovereign funds, pension funds in Canberra, Sydney, Shanghai, Tokyo, or Seoul can have a huge impact globally across financial markets. So tell us more about that, your reflection about, the relationship or lack thereof between securities lending on the one hand and ESG.
Yeah, thank you so much. And what's been really interesting in the ESG space, you brought up kind of like different drivers in the market. Regionally, they're kind of different trends, and that can be done through regulation, but also investors really making an impact on kind of what they're doing with their practices and integration. And so after that December 2019 announcement, there was genuine concern of contagion amongst the world's largest lenders. And so while this has really brought the conversation about the integration of securities lending and ESG investing to the forefront, the space is really ripe for more research and thought leadership. That's really kind of like a big takeaway from our paper. So earlier this year, as you noted, my colleague Travis Whitmore and I conducted a literature review. Really, we needed to understand what was happening and go beyond just the metrics of what was happening to instead look at what we knew from empirical academic studies. And so while I don't represent the business, our paper was meant to add context from foundational research to the conversation with practitioners who are very much so, thinking of their investment process and their investment philosophies. And so that's where, you had the announcement out of Japan, and it, many other asset owners started to think about their securities lending programs. And so what's important to note in terms of, I'll note some kind of key takeaways from our paper, and where kind of we see this the space moving from a research perspective, at least. So some key takeaways. Many assume that the short-term nature of borrowers is really at odds with longer-term investment horizons, and when in fact the existing research suggests that this is just not the case. And so, and for context, think of short sellers. Short sellers are viewed as informed sellers. So in theory, by preventing them from expressing negative sentiment, you're slowing the speed at which news is incorporated into the market. And so they're pretty good, these short sellers, at anticipating a decline in price. And we find in these studies that they're not responsible for driving asset prices down. So on top of that, there's a discussion around liquidity that really is put out by empirical research in the space. And so those studies suggest that constraints on short-term selling reduces liquidity. So after a few short selling bans, which researchers were able to study, where bid-ask spreads, which are used as a proxy for liquidity, significantly grew. So that's, where's that concern of reducing liquidity in the market. And so in a way, securities lending facilitates short-term selling, obviously. It doesn't seem to be any harm to these long-term investments. And so the logic is that, again, preventing potential disruptive price bubbles actually improves market efficiency. And so that's kind of the traditional securities lending research. From leading ESG research and case studies, we know that many lenders are incorporating ESG into their lending programs. Really think of it in kind of like 3 ways. And there's a lot of iterations going on here, but investors are dictating which stocks are lent. And so some are only doing it, outside of country. They won't lend in-country stocks. They're setting thresholds to maintain ownership, and they're recalling stocks to vote on ESG performance. And so they're kind of putting some guardrails around their securities lending program. And what's important about this is a lender's voice is part of their stewardship efforts. And this is how they communicate what they see as ESG, material characteristics as shareholders. And these long-term investors think multi-generationally. So that really aligns with many ESG characteristics. If you think of climate finance issues like carbon intensity, that's slow to change and it's not adequately priced right now. So there are concerns that through short-term borrowing, they're potentially undermining their stewardship efforts by mispricing or not considering ESG characteristics. And this is exactly what I think the space is really ripe for research on. So as securities lending and ESG investing continues to evolve, new insights are really going to stem from studying those shifting dynamics between the borrowers and the lenders and how this translates to change a company's performance on ESG characteristics, not just the kind of traditional research in the space, which only looked at kind of the asset value.
Right. I mean, it's interesting because it has become, one of the most interesting issues in the world of finance today, because if you flip through the pages of the financial press, be it in Sydney or London these days, that issue, which was a niche issue, has almost moved, center stage, partly because of the COVID crisis and the fact, that early on at the beginning of the COVID crisis, many bourses, many national stock exchanges in Europe actually banned, short selling for months or for 2 weeks, etc. And what's interesting, and I'm speaking here today to some of the people in the audience. I know we have some, beneficial owners in the audience today, and both asset management companies and pension funds and sovereign funds. And I know for a fact that some of them were until recently lukewarm at the idea, of empowering short sellers, etc. But I think these perceptions are changing, and they're changing rapidly.
And I think part of it is also the changing conversation. I think that asset owners are bringing this up to, their partners in securities lending, so the firms that they're working with. And, I think that, again, this kind of brings this conversation to the forefront and opens a dialogue on this. And so, again, what's interesting about the space is it's ripe for research, but also I think that, all of the kind of parties involved and the market participants in the securities lending space are ripe for conversation around this. I don't think it's something that that's kind of like can't be integrated. So.
Sure, and even literally in the past few days, we've seen the Wirecard, the whole Wirecard saga in Germany, and which had ramifications across Germany, Switzerland, and Austria, and many of the or some of the pension funds and regulators in Switzerland, Austria, and Germany who were like lukewarm towards short selling, even them, they've had to reassess their perspective because they had a real life example where actually, a real life example, a story where short sellers and hedge funds were actually doing everybody else a service by shorting, the shares of Wirecard when a lot of people were buying it blindly.
Right. And actually, there is some research of some short sellers who are incorporating ESG characteristics. It's just not a ton of research yet. And so again, more research to be done in the space. It's challenging to do it, but it'll definitely drive the conversation forward.
Sure, and actually, also in the very recent past, like literally in the past, 5 or 6 weeks, a handful of new long-short strategies were launched in London, Paris, Zurich, and Frankfurt by large investment houses, focusing on what you said, long-short with an ESG perspective, and so perhaps more business for securities lenders. So things are clearly changing and moving really, really fast in that space. So very interesting to watch. Yeah. Now I'm aware of time, so I don't want to hold you unduly, but another key issue I think which has surfaced and accelerated is social bonds. I mean, it's linked, of course, in part to the COVID crisis, but social bond issuance by corporations, governments, by supranational institutions in the past 5 months, they have broken all records. It's really amazing, the tens of billions issued in the past 5 months. And of course, it's linked to, healthcare and biotech. So a lot of that money which was raised will be used, for social purposes linked to providing vaccines or, social coverage, etc. And also another segment which has broken all records in the recent past is green bonds issued, by Asian and European companies, supranationals, governments in the past 5 months. So what I'll ask you in a very concrete way, tell us about the tools that you already have in place today that allow you to compare and contrast companies when it comes to the treatment of labor, for example. How is it captured, and how do you test if a company's efforts are real?
Yeah, that's a perfect question. And so, even during this era of climate change, this COVID pandemic, and you're talking to kind of these announcements and kind of issuance this year, it's really kind of highlighted longstanding societal issues that have escalated these social and governance characteristics into the conversation of ESG investing. And so what's interesting on the data side, and I will speak to research that we did on listed equities, but it'll speak to basically corporate debt issued in those markets. So new research advancements in ESG data have really facilitated this change in the conversation. So one that was previously really dominated by environmental themes, which you see in a lot of the regulation that's existed. Regulation takes a while to come out, and so in Asia and Hong Kong and in the European Union with the green taxonomy, we see a lot of environmental metrics, science-based, corporately reported. But there's more space and kind of like more meat to sink your teeth into in the S&G space that's really come out recently, and it's through some new advancements in technology and data. So with regards to the social bonds and green bonds, we've seen the social bond space, which was designed off of the success of the green bond space. Both markets really have grown in multiples since their inception less than 15 years ago, and to your point, exceptionally this year. But there's still concerns around green and good washing. And so as a result, investors are really demanding more transparency, and they're really scrutinizing what the data is capturing in an effort to understand if it's actually applicable to evaluate in investment and opportunities and risk. And so research is really trying to make progress on these concerns, and particularly in the equity space. In a paper I co-authored with Professor Sarafan and my colleagues Stacey Wong and Alex Chima-Fox earlier this year, we studied the COVID-19 induced market crash in early 2020, where investors were really wondering which companies would outperform during this downfall. And that translates to really, how can you identify more resilient companies, those earning less negative stock returns during the downfall? And so a firm's resilience is their capacity to adjust to changing external drivers and their responses to these drivers. And so as for concern on this being simply kind of like cheap talk, what better time to test this and these corporate responses than during a market crash? And so we kind of had a really ripe opportunity, albeit extremely terrible for everyone in the world, because it very much so induced this massive drawdown in the S&P 500. So to start, for context, the foundation of our study was on 3,000 global listed equities across 47 countries between February 20th and March 23rd. So a really short period that was just during that S&P drawdown. And since we scoped our study to this really short period, we needed ESG data that was relatively, needed to be high frequency rather than annual ratings. And so in order to study these changes, we needed something that would be, that would move within a short and volatile period. And so on top of that, we were focusing on ESG issues that were related to stakeholder management theory. So stakeholder management theory suggests that better stakeholder relations can translate into better corporate business outcomes as these relationships become strategic resources. So think about that as, having dynamic relationships with key stakeholders like labor, suppliers, and your clients. So a company is going to perform better by delivering and, having these relationships. They're going to perform better and ultimately deliver to their shareholders. And so we studied the association between returns and a company's responses to issues that would be likely pertinent during the crisis. And we called this company's crisis response.
And that was over a 3 months period or 2 months period?
6 weeks.
6 weeks, okay, wow.
It was a 6-week period, so super short.
Oh, wow.
Yeah, and so companies would be making announcements like either, we're protecting our labor force, we're trying to get them to work from home, or there were other companies that were saying things like, you can't take paid sick leave, you have to prove that you got COVID at work. And what's interesting is, depending on these corporate responses, they really had very, we found literally a systematic relationship with returns, to be quite frank. And so, and there were a few different, we studied this corporate crisis response, and we found this systematic relationship with returns, but we also captured other things. So other company level measures, other industry level measures, and country level measures as well, to understand basically like what would amplify the returns. So if the idea is, and sorry, I just wanted to note that the data there, we had to use sentiment data. So it's really an outside-in perspective because it's moving so quickly. Companies can't report on this.
So we're using some AI tool to screen the flow of information?
So we use as a data provider that leverages natural language processing. And so, and what was great was, in a data provider that is going to use natural language processing, they were also, creating special data sets for the COVID crisis, specifically for research. So just a space that was moving really, really quickly. And the natural language processing, it was in 11 different languages. So which is to say that, you could have bias if you're only translating things from an English perspective. And so you need to have it in multiple languages to kind of chip away at that bias. But yeah, so we used this outside-in perspective, and it was a very unique perspective that allowed us to kind of test this. And of course, we're controlling for Fama French factors and other traditional drivers in terms of kind of what's going on with the economy. But what was interesting, I had said we studied it at a corporate level, and we saw that these responses could be amplified. So our results were really stronger for firms whose crisis response received a lot of attention. So think of like a snowball effect. When you have something positive, that, there were a few firms, even, within hospitality, which was talking about, making sure their employees were paid and had health care, and making sure their suppliers were paid on time. And these outperformed against their industry peers. And then when they got a lot of attention, that seemed to kind of get amplified. And so in addition, we found an amplifying effect in highly impacted industries. So kind of two types of industries I would bucket that. one, those industries with really manual tasks that are difficult to do remotely. So like food processing, meat processing factories, textiles, as well as those with massive spikes of unemployment due to social distancing and travel bans. So think of like hospitality and airlines really got impacted by that. So what's important about this research and the questions that we've been fielding on it is, who were the winners and losers during the market crash, and really what I think is kind of profound about this is investors who were universal owners. This is something important to look at an industry level, which is to say they could be universal owners, have exposure to all of these industries, and actually identify, those more resilient companies down to the industry level. And actually some of our characteristics went down to the sub-industry level. And so what's interesting about this research is it really challenges the notion that a company needs to sacrifice performance in order to protect their personnel. Because strong stakeholder relationships are really important for resilience. And so it's a compelling example of how advances in natural language processing can really help investors navigate volatile market periods, but also kind of cut through that idea of cheap talk. That's what we were able to cut through here, and add some transparency to what's going on with these announcements. So as these innovations are happening in social and governance, on the environmental side of things, we're testing, we're continuing to make progress in the space by testing the merit and applicability of different types of climate data. And all of this helps investors to improve their outcomes, basically.
It's really fascinating because it's really the way of the future, because, up until recently and to a large extent, even today, you had that artificial dichotomy, and people said, we're buy and hold, Graham and Dodd, mom and pop, CFA, long-term investors. We don't want to touch, we don't want to see these AI or machine learning. It's for the quants, etc. And I think one of the things that is happening right now is that, that difference is exploding or imploding. And because of the crisis and because of, research conducted by you guys at State Street and Professor Serafim at Harvard, it's clear that even if you're a buy and hold, long-term stock picker, it can be very useful to combine your traditional, perspective, not throw it away, just keep it, but combine it with new tools and, AI and machine learning, and it's a case in point, what you guys did, can allow you to extract more alpha in the short, medium term.
Exactly, yeah. And just to kind of speaks to the point of investors are at this point need to start to get more sophisticated about ESG and not just, accept everything as perfect, continue to ask questions. And that's part of being more sophisticated in the space. And I think it can be integrated in various types of, I've worked at firms where it's been integrated in different types of investment processes. And so, whether you're a fundamental analyst or a quant researcher, at a hedge fund or whatnot, it's really, it's going to be unique for the landscape of investors, but definitely a point in time to get more sophisticated and maybe read some papers on this space.
Speaking of which, I'm aware of time, and I know that you have to go soon, so I'm going to keep you for a few more minutes. By the way, full disclosure, I haven't read that 6 weeks analysis at the onset of the crisis, so I'm going to do it because it sounds fascinating. But I had a question for you about an earlier, different State Street, Harvard University a paper that I think you also co-authored with George Serafim at Harvard, but it was looking at a longer period. And I think it was looking at 2016 or 2017 until the end of 2019, so like a 3 years period or 4 years, and using that decarbonization and green strategies analysis, blah, 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 over a long period of time for many large liquid companies. I think you guys at State Street and Harvard were able to prove scientifically or, based on a deep statistical set that, companies which on average were more ESG centric would generate extra alpha, blah, 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 which makes a lot of sense, intuitively, but what's great is that you can demonstrate that, or you have demonstrated that scientifically. But playing the devil's advocate, I had a question for you. So it's all nice to look at, you know, these figures, and you can prove things neatly, but some of the skeptics may tell you that fine, but you looked at 2017 until early 2020. In those days, until recently, there were fewer ESG-driven investors. So perhaps there was a bigger opportunity pound, right, to draw fish from. And it's a period of time during which, you know, the price of oil was perhaps on a once-in-a-century downward trajectory, which continued into 2020. So the question is the following, you know, as ESG moves center stage and more and more investors are converted to the gospel of ESG, is it possible that in the future, you know, ESG will become a victim of its own success, and that investors won't be able as easily to extract that extra alpha?
So I think what's the important takeaway here, I love this question, and happy to speak to. We put out two climate finance papers with Professor Seraphim, and again, my colleagues at SSA, Alex Chima-Fox, Stacey Wong, and David Turkington. The big takeaway here is that in a competitive market transitioning to a low carbon economy, investors need to get sophisticated about decarbonizing in order to improve performance. And so I'll speak to our findings on two papers which speak to these decarbonization factors which we studied. But that's really the big takeaway here, is that, you know, in the first study, it's an investor behavior study where we study understand how real money moves around low carbon strategies. And in the second one, we look at different data and try to leverage the merit and applicability of the data to improve portfolio outcomes. And so, you know, it is a competitive market, and more and more, not just countries, but really, you know, the global economy is moving to this low carbon economy. So it is going to increasingly become competitive, and it's why it's a ripe opportunity to kind of, again, lean into this complexity in the space. And so and I'll start with the first paper that we put out. So in 2019, and it is listed equities again in this space. So, and we're basically studying kind of transitional risks. So think of market drivers, regulatory space, all of this is impacting listed equities. So in 2019, we set out to measure how institutional money in aggregate moves around low carbon strategies and the effect in return profiles. So you know, do flows contain information about financial performance of low carbon strategies? And so to test this, we design and monitor the performance of 6 strategies in the US and Europe, which we call decarbonization factors. And so these regional strategies take long short positions on lower carbon intensity firms, industries, and sectors within the respective industry sector and market. And so it's on you know, US and European listed equities during this period, and across regions, what we saw was the most aggressive decarbonization strategies produced the highest cumulative alpha. And this is after controlling for traditional factors, so the fama French factors, as well as the price of oil, actually. So okay. that oil piece is, yeah, and even early in 2020, you know, we have our updating that research and speaking to kind of updates in that research. We're controlling for the price of oil here. Okay. And so between 2009 and 2018, investors that had significant exposure to the European factors that we had designed, they actually would have experienced significantly stronger performance relative to the US. And it's really actually exemplified after 2016, when almost all of the US factors experienced outflows. So that's an effect that we didn't see in Europe. You know, it seems to align with the administration change in the US. And so it'll be interesting, again, there are interesting factors to kind of track over time as regulations and there kind of these shifts in the market. And so as we continue to study any predictive power in the flows information, And for context, the flows that we're using here are based off of State Street's highly aggregated and anonymized flows data, and then we map it to these factors. And so that's how we understand not just the factors themselves and how they're performing and kind of what the loading is for other traditional factors in the market, but how real money is moving around it. But we wanted to build on this research. So we're continuing to work on, we found that there's this relationship with flows and performance, but we also know that investors are navigating a really murky landscape of environmental data and environmental metrics that are kind of confusing, right? They're capturing different things, they're measured in different ways. And so we wanted to respond and kind of help investors navigate this space. So we built on this research and tried to make sense of the scope 3 environmental space. So when you think of scope 3, you've got our first paper was scope 1 and 2, so operational carbon data. So that's what a firm uses to just operate the buildings they own. But when you get into scope 3, you're thinking upstream, downstream. So the suppliers, the carbon intensity from the suppliers that a company works with, but then also the carbon intensity from the products and services that they put out. So in just September of this year, we kind of pivoted, away from investor behavior to understand how we can, help investors make sense of this different type of climate data. And so and the idea with this was to demystify the merit and applicability of these data and present a practical approach to portfolio construction. So for this study, we focused on the US, but it had to do with, again, we were mapping so many different data. So it narrowed our universe. So it was across 43 industries between 2013 and 2018. And again, we did these long, short strategies that were industry neutral. On each climate data. So we were looking at company reported data, we were looking at total value chain data, which is modeled and estimated, and we were looking at as well analyst ratings. And so we ran tests with materiality indicator and tested, again, traditional Fama-French factors to understand kind of the loading. And we found that performance on these portfolios based on a single type of data actually really varies by industry. So looking at the industry level, the carbon metric that has greater variation or dispersion across firms is more effective at predicting returns than the others. So what we found really was that we could use this dispersion at an industry level to identify when a data type was additive. And it was only by understanding the construction of the data that we were able to kind of organize this research. And this dispersion piece is really intuitive. So firms and industries that anticipate pressures from regulators and clients, some of those firms are going to invest strategically to differentiate themselves on these climate measures. Think of the difference in operations and the supply chain of like a chemicals company to a pharmaceuticals company. Yeah. So chemicals companies, they convert all these raw materials into different products that are used by many industries. And this is really a heavy lift in their supply chain. And so we see this not only in what they report, but in the modeled data. So there's large dispersion on the company reported data, but also the modeled data kind of corresponds, it correlates with that large dispersion on the operational carbon data. So we see, again, like really high dispersion in that industry, but that's not the case in pharma. So while we use one type of climate data for chemicals, we're going to use actually analyst ratings for pharma, because firms in that industry with less dispersion, that's exactly when you need qualitative assessments to shed light on how a firm is managing opportunities in the transitioning, the transition to a low carbon economy. And that's going to be relatively more additive. And so it's the idea of kind of wrapping your brain on not only, what's being captured, but how it's being captured, and understanding the pros and cons and all of those type of data. So then we use these insights in a rules-based trading model. And so our rule is a systematic process of choosing different types of data of climate metric data across industries. And so really what we found was that playing to the strengths of different types of climate data can really help investors design strategies that not only manage climate risk, but also increase risk-adjusted returns. And so, when we compared a simple value-weighted long-short portfolio of a single climate measure to our rules-based approach, we found significant improvements in the risk-return profile. The alpha significantly improved. This is between anywhere just shy of 200 basis points to just shy of 400 basis points annually. And so, in short, while ESG has certainly moved mainstream, we're not fully pricing material characteristics into the investment.
That's great. I'll need to stop you there because I'm aware of time.
Oh, no!
But the thing is, what was great about what you just said now is that even though, the premise of your approach seems to be a lot of, using a lot of quantitative metrics, yes, you kept on saying that you also combined it constantly with qualitative assessment. And I think it's very interesting because it proves one more time that it's not, black or white. It's like combining both can yield, superior risk-adjusted returns for investors. And also, if you're a researcher, it can yield to more interesting, more triangular or triangulated results. Because if you're only qualitative or only quantitative, you're almost certainly missing out on some data. And I think having both at the same time is great. And we'll make sure early next week for all of us, all those listening to or joining us by Zoom or audio or LinkedIn or Facebook today. So all of you next week, we'll make sure to email you these joint State Street Harvard University research papers. Once again, I'm aware of time, so we only need to wrap up, sadly, but that fascinating conversation could have continued for hours. And what I want to say is that it was really great to have you today. And, once the COVID crisis recedes, which hopefully with the new vaccine, will be soon, we'd love to, welcome you in the flesh in Singapore in the spring of 2021 at the Singapore Economic Forum with you and your State Street colleagues from Boston. And once again, it was a pleasure to have you with us today. And as we say in French, à très bientôt. À bientôt.
Thank you.
And so one more question we had for you today, and I think we'll end on that cautious note of optimism, because there's a lot of news, as we said earlier, about ESG and the new Green New Deal. So things, the stars seem to be more aligned now on both sides of the Atlantic pool. So the question we had for you is the following: what's on the horizon when it comes to research in that space?
So on the horizon, we're looking into, move out of just equities and move into actually FX research. And so we're doing this in two different ways, where my colleagues, Stacy Wong and Alex Chima Fox, are working with Professor Seraphim to understand how physical risk, so, think of, floods and fires and how these things are highly localized, how that's linked to currency movement. And so we're looking at it from, FX from a climate resilience perspective. And also we're actually looking at this from a country's governance quality. So we're taking kind of S and G and then E and studying them in these two different ways. And so from the governance quality, basically we want to better understand risk in markets. So it's interesting because there seems to be a risk story here that's not yet been explained by other market factors. And so it might be, it might affect the interpretation of what carry trade returns reflect and why it works, why it hasn't worked more recently, and how it could work moving forward. So continuing to move into different spaces and leverage different research. So we encourage you all to stay tuned to the research coming out of State Street Associates.
That's great. And I think it dovetails with some of the concerns by sovereign wealth funds and central banks across the Asia Pacific area. So I think, many people will be eager to read your prose on that space. Once again, thank you for joining us today. It was a pleasure to have you with us at the conference. And one more time, we look forward to meeting you in the spring of 2021 at the Singapore Economic Forum. À bientôt. Cheers.
À bientôt.